Hello, everyone, and welcome to our actually second webinar of the year. We've had two back to back, and it's about a very important topic, and that is one that we all love and enjoy, and that is taxes. We know it can be complex, and today's session is designed to provide clarity, guidance, and an opportunity to ask questions directly to our expert panel. Today, we have with us Dale Mason, who's a CPA from Dale Mason CPA and Co., as well as Jose Sobrado, who's a CFA and president and founder of MG Capital Partners. So since last year, we've made some enhancements to our platform, and I just want to introduce them to you very quick. You can access the chat and ask a question features to submit your questions anytime during the session. We had a lot of questions yesterday, so today we expect the same, and we will get to them, or as many as we can, at the end of the session. Additionally, you can learn more about our panelists in the speak moment to take the survey at the end and complete it. Your feedback is important to us, and it helps shape our future events and provide you the financial content that is important to you. You can also explore our latest auto loan promotions. So if you're looking for a loan, refinance a loan, new or used, I can pretty much guarantee you that we have the best rates in the marketplace. And feel free to enjoy those emoji reactions. Super fun. Tells us you're still out there and engaged. And we want these sessions to be as interactive and valuable to you. Regarding closed captions are enabled in the media player, streaming our cameras, and if you would like to activate them, please click the small CC button at the bottom. We will put the presentation in the chat, and additionally, you will get a recording of the presentation after this session. So love that you're here. I'm going to hand it over to our first speaker for an engaging session. Thanks, everyone.
Thank you, Marilyn. Thank you for that kind presentation, and thank you for hosting us. Welcome, everybody. We're excited to be here and to talk to you about taxes. Hopefully, you are as excited about taxes as Marilyn and I and Dale. But maybe you have some questions as we head into tax season. Hopefully, this is a place where you'll find some answers, as well as a more general discussion as well on the implications of taxes more generally on your finances as an employee of IDB. Today, we have a lot of content to cover, but we also want to get to as many of your questions as possible. So please type your questions. We will have plenty of time at the end of the session to answer them. We do answer them in the question that we receive them. So the sooner you can enter it, the higher chance you'll have that we can get to your question. This is our agenda for today. Well, before I start, a quick disclaimer, of course. Unfortunately, US tax law is very complex, presumably the most complex in the world. So by all means, we will not be able to cover everything that may be relevant for your own personal circumstances. So please, nothing that we can say today should be construed as tax, finance, or legal advice. Always consult with a professional tax, financial, or legal advisor based on your own specific circumstances. There's always going to be exceptions to the exceptions to the exceptions of any rules discussed today, and it's important that you understand those as well when making decisions. As far as our agenda for today, we want to cover general aspects about tax residency, what it is that makes a person a tax resident, and what does that mean for income taxes. We want to cover some of the tax changes that occurred in 2025 that may affect you. And very specifically, we want to talk about reporting of foreign financial assets, particularly or as it relates to your pension assets. And we want to also talk about the exit tax, which are concerns that affect many of you as employees of IDB. So as I said, let's begin with tax residency. What makes you a tax resident of the US, and what does that mean for tax purposes as opposed to being a non-resident? There is basically generally 4 ways in which you are considered a tax resident of the United States. And it's either through citizenship, through lawful permanent residency, in other words, the green card, through the substantial presence test, or through the 6013G election. Of course, if you're born in the US, if you're a US citizen, then you are always taxable in the US. Importantly, you're taxable in the US as a tax resident, regardless of where you reside in the world. Think about this because this is very unique. This is very particular to the US. If you're a US citizen, you can leave the US and relocate anywhere in the world and still remain a tax resident. This is very different than most other countries in the world. Probably there's one other country that we know of that follows the same principle. In most other countries in the world, once you leave the country, even as a citizen, if you go live abroad, you're no longer considered a tax resident. The US is different. As a citizen, you will always be considered a tax resident. And that means that your worldwide income, again, regardless of where you live or where your income is generated, is reportable to the US and taxable in the US. Now, think how that might affect perhaps your children. Perhaps you're not yourself a US citizen, but perhaps your children were born here in the US and are US citizens. In the future, you may go back to your home countries. Your children may follow you, never return to the US. As long as they remain US citizens, when they have income, that income is reportable and taxable in the US. This does affect many children in the world that are US citizens and fail to comply with the US income tax obligation. So that's a very particular aspect of US citizenship that is important to understand. Now, if you are married to, maybe you're not a US citizen or a green card holder, or you don't spend time in the US, but if you're married to a US citizen or a US green card holder, you can also elect to become a tax resident. This is something we covered extensively on our previous presentation for G4 visa holders, but you can always elect to be treated as a US tax resident if you are married, if you're a spouse of a green card holder or US citizen. We won't go into too much detail here, but understand that that is an option. That may be an option for some households. And it may be advantageous because it could, in some cases, reduce your overall tax burden, your tax liabilities. Now, we will talk more today about the green card, being a tax resident by virtue of a green card, and the substantial presence test. So if you apply for a green card, you will become a tax resident, of course, and that will happen effectively your first day of presence in the US with a valid green card. Perhaps that's something that you may consider when you retire, or perhaps sooner than that. Perhaps if your children are able to sponsor you for a green card, but you will become a tax resident from the first day that you're present in the US with that green card. If you receive the green card when you're living outside of the US, you won't be automatically a tax resident when you receive that green card. It's actually the first day when you travel back to the US with that valid green card. Now, if that hasn't happened by January 1st of the following year, then January 1st is also the date when you will be considered a tax resident. You could also become a tax resident by virtue of the substantial presence test, which we will discuss in a second. If you are eligible for tax residency under both requirements, it's always going to be the earlier of the two, the earlier of the green card test, the first day of presence with the green card, or the earlier of the substantial presence test. So what is the substantial presence test? If you spend enough days in the US, physically in the territory, then you will become a tax resident by virtue of those days of presence. Except if you are a full-time employee of an international organization. As a full-time employee of an international organization, your days are exempt from counting. Regardless of how long you spend in the US, you will not become a tax resident by virtue of the substantial presence test if you are a full-time employee of an international organization. And that's also true, not just for you as the G4 primary, but also for your dependents, your dependent spouse, and any unmarried children under the age of 21 will also be considered non-residents regardless of how much time they spend physically in the US. But if your days of presence do count because of your visa status or because you're not employed full-time for an international organization, then this is the rule, this is the formula that will apply to determine whether you are a tax resident or not. The formula is you count 100% of the days in the current year, 1/3 of the days in the year before that, and then 1/6 of the days in the year before that. The sum of that, if it's more than 183 days, then you're considered a tax resident for that current year. As long as you've spent at least 30 days in the country. You can never be considered a tax resident regardless of this formula if you haven't spent at least 30 days in the current calendar year. But under this test, people that spend on average about 4 months per year over an extended period of time can be tax residents. So the fact that it's 183 days can be a little bit misleading, since days from previous years also count. On average, you're really talking about 4 months per year of continuous presence that would be required to make you a tax resident. And this affects anybody that comes to the US, perhaps even on a tourist visa, right? On a tourist visa, you could potentially stay up to 6 months. So your family members that may come visit you from abroad, if they're doing that regularly year over year, and on average end up spending more than 4 months each year, could certainly become tax residents as well. So now that you understand tax residency, you need to understand that if you are a tax resident under any of these tests, then you are subject to taxes in the US on your worldwide income, regardless of where that income is generated. That's very different than being a non-resident, in which case only low US source income is taxable in the US. As a tax resident, global income, regardless of where it comes from, is taxable in the US. And the one thing that brings to mind, the concern that you should have in that case, is always the risk of double taxation. Just because you're a tax resident here doesn't mean that perhaps you're not paying taxes also somewhere else, right? As a non-resident, if you have assets abroad, you could be subject to taxation outside of the US. As a US tax resident, you would have to also report and pay taxes on that income. So you want to make sure that you're not subject to double taxes. If you're paying taxes outside of the US as a non-resident, you want to make sure that when you file your taxes in the US, you declare those taxes that you paid abroad and get credit for that, so that you're not being doubly taxed. Foreign tax credits are very important for people with assets taxable outside of the US if you're a tax resident here. You also need to be familiar with the Form 1040. Every year on April 15, on or before April 15th, if you're a tax resident, you have to complete Form 1040, which is your income tax return for the year. Federal tax returns may be extended. Potentially, you could file later than April 15th, as far as October 15th through the use of Form 4868. But extending your filing deadline does not extend your liability. If you don't pay the taxes that you owe by April 15th, you will be subject to interest and potentially penalties. State returns, you may have to also file local state returns, and those are also generally due by April 15th. Now, filing your annual tax return on April 15th is not enough. If you owe taxes, you may be required to file quarterly estimated taxes. So these are estimated payments that you would make throughout the year in anticipation of the April 15th filing deadline. Those estimated taxes are due on April 15th, June 15th, September 15th, and January 15th of the following year. If you owe taxes and do not make these quarterly estimated taxes, you could be subject to interest on the underpayment of taxes. Currently, interest rates are high, so it is currently a 7% interest that you'll be assessed on any underpayment of taxes. And if that's the case, you should always be sure to complete Form 2210 to pay that interest that you would owe. So with that introduction to general taxation, let's talk about specific changes to the law that occurred in 2025 that may affect you. Of course, This is driven by the passage of the One Big Beautiful Bill, which passed in July of 2025 and changed the law for 2025 and future years. But we are only going to discuss a few of the changes, the ones that may be more relevant for you. The act itself is very broad, covers many aspects of the tax code. So there may be other things that we're not discussing here today that could also affect you. Of course, there is if you're filing taxes in the U.S. as a tax resident, you can benefit from a standard deduction. So your taxable income is reduced by a standard deduction based on how you're filing taxes, jointly, married, filing separately, or head of household. Those standard deductions were increased as a result of the new law. So the current standard deductions are considerably higher than they were before. And you can see here what they will be depending on your filing status. Now, in addition, in lieu of the standard deduction, of course, you can always itemize deductions. If your itemized deductions are higher than your standard deduction, you can take advantage of those. And there were also some changes in the itemized deductions available to you as a result of the new law. Property taxes and state income taxes are deductible, and that was increased. But you can also deduct interest on home mortgages up to $750,000 of principal, out-of-pocket medical expenses up to 7.5% of AGI, and charitable contributions. If you have these types of expenses, it's important that you consider whether itemizing those deductions can be beneficial, more beneficial than taking advantage of the standard deduction. Particularly on state and local taxes, the deduction was increased considerably. It used to be, these expenses used to be deductible only up to $10,000. Under the new law, the limit has increased to $40,000, $20,000 if married filing separately. Now, the increase is not all at once. It's incremental through 2029 and reverts to the lower amount of $10,000 in 2030. The deduction is also phased out. So if your income is high, you may be phased out from deducting the maximum amount. But again, this is something that may have changed for many of you, and it's worth looking at this when you file your taxes this year to see if it doesn't put you in a situation of being able to itemize deductions as opposed to using the standard deduction. Interestingly, there is also a deduction for seniors. So individuals who are age 65 or older can claim an additional deduction of $6,000 or $12,000 for a married couple if both spouses qualify. Now, this is above the standard deduction. So even if you take advantage of the standard deduction, if you qualify, you can apply this credit on top of your standard deduction. There could be other changes that may affect you as well, but these are some of the most relevant ones. Now we want to talk about, as I said, foreign financial reporting and exit tax, and Dale will help us through these topics.
Thank you, Jose. Hello, everybody. Now, as Jose was saying, if you are a U.S. citizen or other tax resident who meet the substantial presence test, or you're a lawful permanent resident or other tax resident, you're subject to U.S. taxes on your full worldwide income, So what I'm about to talk to you now about is the fact that the U.S. government doesn't necessarily trust you to report your full worldwide income. And so in many cases, you may have to fill out these informational reports. So these informational reports do not cause you to pay any additional tax because you already have to pay tax on your full worldwide income. This is just informational reports in nature. And if you don't file them, you could end up having to pay really large penalties. So it's important that you do file them if you meet these criteria. So the first one that's been around since the 1970s is called the Foreign Bank Account Report, the FBAR for short. It's on a form called FinCEN Form 114, and it's required to be filed electronically. So if you don't file it electronically, you could be penalized for this. So this is not actually part of your income tax return. This is a report that's filed with the FinCEN. Now, who should file this report? All U.S. tax residents, including U.S. citizen, green card holders, and other U.S. tax residents, Now, it's important to note that this form is required to be filed. Now, remember, this form was created in the 1970s. If you have any type of foreign financial account, and if the account in aggregate, if all of you add up all of your foreign accounts in aggregate, and if they exceed $10,000, the equivalent of $10,000 at any time during the calendar year, then you have to report every single one of the foreign accounts that you have. But in addition to that, if you are helping an elderly relative, for example, a parent, for example, by having a signature authority over a foreign financial account, then that is also must be included on the FBAR report. Next slide, please. So your typical foreign bank account report, the FBAR report, you have to file and report your bank accounts, your savings accounts, your checking accounts. But even you may even have to report your foreign annuity or life insurance policy if it has a cash surrender value. As I was mentioning, it's required to be filed electronically. It's due April 15th of the following year. So for calendar year 2025, it's due April 15th, 2026. But the interesting thing is, if you don't file it by April 15th, 2026, there's no extension that you have to file. You're automatically granted an extension until October 15th of 2026. But make sure that you fill this out if you have this requirement, if you meet these threshold, this $10,000 requirement. Next slide, please. Now, another very similar report is called the Specified Foreign Financial Asset Report, Form 8938. This is also called the FATCA report, F-A-T-C-A, FATCA. Now, this has been around since 2011, and again, it's very similar in reporting in nature to the FBAR report, except this form is actually absolutely required on a federal income tax return. So this is part and parcel of your actual 1040 tax return. The requirement is in addition to the FBAR that I just mentioned, even if you have the same accounts to report, again, these are foreign financial accounts. You don't have to report real estate that you own on these forms because these are just foreign financial accounts. But the good news for this particular form is that the threshold requirement for you to have to report is not the low $10,000, but instead, if you're single living in the United States, the threshold requirement is $50,000. And if you're married filing joint, then it's $100,000. That's the threshold. If you're underneath those thresholds, then you don't have an 8938 filing requirement. Next slide, please. So I won't bore you with the detail about what accounts are required in the 8938, even though they're very similar to the FBAR report. What I would say that if you're doing this yourself and you've read through the 20 pages of instructions for the 8938 and the FBAR report, and you can't really figure out which form to use and et cetera, but what I would recommend is when in doubt, go ahead and report on the particular form that you're uncertain about, because again, you're not going to be paying any additional tax because of these things, having to report on the 8938 of the FBAR. But instead, if you don't report the full, all your financial accounts on these reports, then you could end up having to pay a very high penalty. So make sure that when in doubt, report. Next slide, please. What's very important to note is the IDB pension is considered a specified foreign financial asset for purposes of the 8938 form. So what you do is you look at the gross amount of the distribution from the IDB pension, and you combine that with your other foreign financial accounts. And then if you meet those threshold requirements, you have to report the IDB pension on the form 8938. What you use is, again, the gross distribution reported to you on the form 1099-R. That's a form that you get from the IDB that's also given to the IRS. Once you've retired and start receiving distributions from the IDB pension, you'll get a 1099-R form that will also, again, be sent to the IRS. but make sure that you report both, of course, the taxable portion that's shown on the 1099-R as well as the gross distribution. Next slide, please. So let's change subjects a little bit and talk about the exit tax. Yes, there is such a thing as an exit tax if you leave the United States and you give up your citizenship or your lawful permanent resident status, you give up your green card. Now, you could be subject to the exit tax, and if you are subject to the exit tax, you would be considered a covered expatriate. And you don't want to, believe me, you don't want to be a covered expatriate. So when does this happen? When do you become a covered expatriate subject to the exit tax? If you're a U.S. citizen giving up their U.S. citizenship, or you held a green card in at least 8 out of the last 15 years. So basically more than 7 years you've held your green card, and then you give up your citizenship or you give up your green card. And at the time you give up your citizenship or your green card, you meet the net worth or the income tax tests. Next slide, please. And let's go over what those income tax and net worth tests are. So the one that affects most of our clients is the $2 million or more of net worth. And the reason that it affects them is that you take your global assets minus your global liabilities, so your stocks, bonds, real estate, etc., minus your liabilities, which would be in many cases mortgages, credit cards, etc., and that would be your net worth. But in addition to that, you take into account the gross amount, the present value of the gross amount of your IDB pension. That in and of itself may be more than $2 million. And so most of our clients are affected by the net worth test and are over the net worth test. So, and most of our clients that are considering giving up their green card meet the net worth test. And so therefore they can become subject to the exit tax. But in the case you don't meet the net worth test, you also have to take a look at the 5-year annual income tax liability test. So if your average annual income tax liability over the previous 5 years is more than $206,000, then you could also be subject to the exit tax. But again, most people are subject because of the net worth test. Next slide, please. So there are many aspects to the exit tax, but we only have time to go over one of them, which is very, very important. If you trigger the exit tax, then you'll be subject to the present value of your accrued benefit in the IDB pension. So it's treated as being received on the day before you've expatriated, the day before you give up your green card or the day before you give up your U.S. citizenship. So you take the entire present value of the IDB pension, and the taxable portion of that would become immediately subject to tax at the progressive rates going up to 37% now for federal. So you don't want to do that. Many people that are considering giving up their green card, and we do the calculations for them, wind up with a potential liability of $200,000, $300,000, $400,000, and that's immediately due. So whenever you're thinking about giving up your citizenship or your green card, you definitely should take advice to see what the implication of this would be to you with regard to the exit tax. Next slide, please. Okay, now we have the question and answer session. So Jose, what do you think?
Thank you, Dale. We have quite a few questions, so let's get started. We're looking forward to getting to them. The first one refers to, it says, for the 2024 tax period, do FBAR and FATCA would have had to be done if one became a green card holder in May of that year, and then later retired in December of 2024?
So as Jose was mentioning, the substantial presence test doesn't apply in your particular situation. So we look at the green card test. And if you got the green card in May, is that right? Was it May that May, she got her green card? Then you became a tax resident at that point. Now, for FATCA purposes, that would be the 8938. And what the law tells you for FATCA is that if you had a tax filing, if you don't have a tax filing requirement, remember the 8938 goes and is attached to your tax return. If you don't have a tax filing requirement, then you don't have to file the 8938, even though you might meet those threshold requirements. But if you don't have a tax filing requirement, which you might not have since you're saying that all your you don't have any taxable income, then even after you receive your green card, then perhaps you don't have to file the 8938 because you wouldn't have a tax filing requirement. But it gets a little bit complicated, because if you became a green card holder in the middle of the year like you did, that means that you are a dual status alien. So that means that you were a non-resident at the beginning of the year and a green card holder or U.S. tax resident toward the end of the year. And so therefore you have to file a dual status tax return. And if you have to file a dual status tax return, you're not eligible for the standard deduction. Now, you are eligible for itemized deductions, but that means that you would have to file a tax return if you had any itemized deductions to claim. So it gets a little bit fuzzy here in your particular situation, that you may actually have to file an 8938, because you might actually have to file a tax return even if you had $1 of income, because you don't get the standard deduction in a dual status tax year. Now, with regard to the FBAR is due no matter whether you have a tax filing requirement or not. So that means that if you had foreign financial accounts of over $10,000 when you became a green card holder in May, you do have an FBAR filing requirement for 2024 if you had that account open at all, or those accounts for any time after May of 2024 when you became a tax resident. So you probably do have an FBAR filing requirement for that year.
Thank you, Dale. And the next one is a very open question. It simply says, what do we do about DC taxes? Do you have any general comments about filing taxes in DC?
What do we do about it? Well, if you're a tax resident of DC, then you have a filing requirement. And I assume that you're a tax resident because you're on this webinar, not yesterday's webinar, being a G4 visa holder. So you probably have both a federal and DC tax filing obligation.
A green card resident that is consultant at the IDB does not pay federal and Maryland taxes. What about California? Are you aware of any special requirements in California?
Say that again, Jose. What's the question again, please?
The question is, this person is asking if a consultant at the IDB needs to, who lives in California, needs to report their income in California.
Okay, so a consultant, typically the IDB treats consultants as employees, and therefore if you're an employee of an international organization, both the federal and state, I think there's a mandatory state exemption as well for all the states. So if you're exempt from a federal tax, then you're also exempt from state tax. That should be the case, even if you're in California.
The next person is asking if green card holders need to report interest income received on Form 1099 INT. Absolutely, yes. So even though your salary perhaps is not taxable, any other income that you receive as a tax resident could be interest, could be dividends, could be capital gains, could be rental income, any other type of income that you have. If you're a tax resident, you have to present in your tax return. Yeah, the second part of the question is whether the origin of the funds matter. The person says if the source of the CD funding is income from IDB, which is tax exempt. So the funding doesn't really matter. What is taxable are the earnings on that investment, regardless of whether the funding comes. If the income, the earnings are taxable, you have to report them as a tax resident.
Yes, and going back to my discussion earlier about the standard deduction, if you're a green card holder and working for the IDB and of course your salary is exempt and you have interest income, of course, that would be taxable now that you're a green card holder rather than a non-resident G4 visa holder, then it may be that your total income is less than the standard deduction and you may not have a tax filing requirement if you don't have enough income to meet that standard deduction, which would probably be the case in the case of interest income. So you may not have a tax filing requirement.
What if I was to transition from G4 to green card? Would I become a tax resident from the moment I received the work authorization, or only after I have received my actual green card? So having a work authorization as a G4 dependent does not make you a tax resident. The income that you receive from your work may be taxable because it's earned while working in the US, but you would still file taxes and report that income as a non-resident. You would only actually become a tax resident subject to taxation on your worldwide income only from the moment you receive your green card. If you live outside of the US, what determines if you need to do a state tax return, Dale?
So if you're living outside the US, a couple of things here. So first of all, if you were living in the US and you became a domiciliary resident, now the domicile rules are very subjective in nature, but suffice it to say, in DC, Virginia, and Maryland, you can be a tax resident because your heart and your intention is to be living there on a permanent basis, and you're temporarily outside of the US. So if you're a domiciliary resident of one of the states around here, then you are a tax resident, and then you would have a filing requirement even if you lived outside the US. Now, if you just lived outside the US and you came to the US on an infrequent basis, you could be a non-resident of one of the states here. And if you earn money that's taxable in one of the states, or if you have rental income from a property located in one of the states, then you would have a tax filing requirement as a non-resident in the particular state that you earn the revenue or had the rental property income generated from that state.
How do I report my IDB salary if I have a full-time international contract, but I have a green card? So your salary is non-taxable.
Right. So I think a lot of people are asking about how do you show that on the tax return? Well, the good news is the tax law says that you are completely exempt from an international organization salary if you're a green card holder or a G4 visa holder. And it's not even that you have to declare it and then take a deduction for it. Instead, it's not like it didn't exist. It's not even part of gross income. So tax filing, I've been doing tax filings for people for the last 25 years that are international organization employees, and we always just leave off completely the salary of a green card holder or a G4 visa holder that's earned from an international organization. So you just don't put it on the tax return at all. I think that's probably
what
the question.
And it also means that if that's your only income, there's not even a need to file a tax return, correct?
That's right.
And then with regards to the $10,000 per account reporting obligation, the question is this per account or in total? And the answer is it's per account, right?
People get this mixed up all the time. So first of all, you look at your aggregate total foreign financial accounts. You look at the highest account balance in each of the foreign financial accounts that you have, and then you add them all up, and then you take the exchange rate on December 31st of that particular year. And if they ever exceeded the equivalent of $10,000 at any time during the calendar year, then in aggregate, you've met the threshold requirement, and therefore you have to file an FBAR and report each and every account that you own that is a foreign financial account. So you don't just look at all of the accounts that are over $10,000. You have to look at in aggregate, did they ever meet the $10,000 threshold?
Mm-hmm. And then, as you said, Dale, this calculation, since it's at any point in time during the year, may not be necessarily easy to make. So when in doubt, report. It's just a reporting obligation.
Exactly.
No taxes are necessarily due as a result of this. FBAR and FATCA are reported for disclosure or for tax payments on those values. As we said, it's just a disclosure, so there's no tax liability resulting from these reports. On the other hand, there could be significant penalties for not reporting them. What if the money in those accounts is money that you send from here? There is no income. Not sure what the question is there, but what we said is that if you owe taxes on investment income, then you owe taxes regardless of the source of those funds. The source of the funds may be non-taxable wages, but any investments you do and any earnings you have as a result of those investments would certainly be taxable. I don't know if I have submitted my 8938 in the past. And when I do my 2025 taxes, should I submit prior year forms, Dale?
This is a question that you'll want to take up with your accountant because there could be penalties imposed. So you'll want to be very careful. You may want to look at the IRS website and Google foreign financial information reporting, delinquent foreign financial information reporting. If you Google that, you'll see a little blurb by the IRS that tells you how to go about declaring prior foreign financial assets that you haven't declared in the past.
And Dale, we talked about the standard deduction and some of the available itemized deductions. Is there anything else that may help IDB employees further reduce their tax liability?
That's a hard question. Of course, if you have dependents, there's the child tax credit, or there's the dependent credit if they don't qualify, if they're not under 17 years old. There's nothing special about being an international organization employee other than if you're a green card holder, your wages are completely tax exempt, which is a great benefit. Were you going to say something, Jose?
Yeah, I was going to say perhaps you're maximizing contributions to retirement plans. Perhaps a spouse in the household is eligible for retirement plan contributions through an employer or through self-employment. You can also set up your own retirement account. So that's a big way to potentially reduce your tax liability as well. What about if they take away my citizenship? Will this trigger the exit tax?
Yes, if you meet those threshold requirements, so it's either you relinquish it voluntarily, or if you have the U.S. citizenship or green card taken away from you by the Immigration Service, then yes, you can be subject to the exit tax even in that case, if you meet the $2 million threshold or the over $200,000 net income tax liability from the previous 5 years.
The next one is a general question about foreign pensions. So how are foreign pensions taxed, maybe taxed in the U.S. if you're a tax resident?
Well, the first thing you want to do is you want to take a look at the tax treaty. Now, there's a very few tax treaties that allow you not to have to report that on a Form 1040, but you first look at the treaty, and most likely the treaty is going to say the U.S. has the right to tax that foreign pension. And then you just report the foreign pension on the pension line on the first page of the 1040. And you'll have to figure out whether you have any cost basis, because you don't want to have to report the full amount of the foreign pension if you don't have to. If it's all a pre-tax pension, which is most likely the case, then the entire distribution would be taxable in the U.S. Now, as Jose was mentioning before about foreign tax credits, you'll want to see whether or not there's any foreign tax on that foreign pension. And then if there is, instead of having to pay double tax, you'll get a foreign tax credit on the Form 1116, the Form 1116. So you'll want to report any foreign tax that you incurred on that foreign pension on your U.S. tax return, so you don't have to pay double tax. Now, you will incur usually double tax at the state level because generally the states don't allow a foreign tax credit.
And foreign pensions are also reportable there on FBAR and the reporting forms?
Yes, that's right.
If a green card holder, this is my first time filing taxes, my only income is my salary from the IDB, which is tax exempt, as we said, do I have to report taxes? No, as we discussed before. If your only income is your wages from the IDB, is not even subject to reporting.
Now, you may want to look at the fact that what we talked about a little bit earlier was that green card holders are considered tax residents subject to the foreign bank account reporting, even if you don't have a filing requirement. So if you had an account abroad, let's say it doesn't earn any interest, but you had an account that's $11,000, then you have an FBAR filing requirement, even though you don't have an actual income tax liability and you don't have a tax return filing requirement.
And then there's a couple of questions I had related again to not filing 8938 or FBAR. What are the consequences? How to remedy that? I think you mentioned some of that.
Yes. So you'll want to take a look at the IRS websites, and it could be as high as $10,000 for failure to file.
How do we report income from dependent U.S. minors earned during part-time job or summer internship? Should those be added to joint return, or should they file their own separate returns? So minors are independent from the parents. So if they have a filing obligation, they would file their own tax return. But they, of course, have the same benefit of standard deduction as anybody else. So unless the income exceeds those thresholds, there wouldn't be a need to file. If your taxable income is less than the tax filing requirement limit and you are a green card holder, do you still report the FBAR? I think you've talked about this.
Yes, we talked about that. Yes, you do. You do have an FBAR filing requirement, but if you don't meet the threshold to have to file a tax return, then you don't have to file the 8938.
As a principal G4 visa holder who became a green card holder and kept working for the IDB, but had a work authorization for over a year before receiving the green card. Again, if the question is, sorry?
Yeah, that's just what you said before.
Right.
It's the first day of in the U.S. with a valid green card is your first day of tax residency.
Correct. And if your question is about your wages, your compensation from the IDB, they're non-taxable either as a G4 or as a green card holder. I'm a green card holder with a G4 retired dependent parent living in the U.S. Does the dependent parent need to file taxes? I'm not sure that a green card holder can have a G4 dependent, right? I don't think I understand.
I don't know that. We're not immigration attorneys, so, but yeah. So it's if your parent is indeed a G4 dependent, and they qualify as a G4 dependent, then I would assume that they would be considered a non-resident of the U.S. But that doesn't make sense to me, as Jose was saying, because the tax law says that the G4 dependent is only the days of presence don't count for residency purposes as long as the visa is dependent on the primary G4. So that's impossible in the case of a green card holder because you don't have a G4. So I don't know what the answer to that is. It's very confusing.
The next question is again about dependents. In this case, somebody who earned less than $2,000. Again, children, if they're tax residents here, they file taxes separately from their parents, and $2,000 is certainly below the standard deduction. So that income is non-reportable, not subject to any taxes.
But they probably will want to file because it's very likely that if they earn $2,000, they may have like $100 of withholding or something like that. And so they can get their entire withholding back if they file a tax return and claim it back. Because as Jose was saying, a dependent who's under the age of, I can't remember, 18, would, and is claimed as a dependent on the parent's tax return, is eligible for a standard deduction up to the earned income that they've earned, which is $2,000, and then so they can file and then claim the withholding back as a refund.
Right. So if they were employees subject to withholding on their wages, that's an amount that could be claimed back. How does having signed an I-508, request for waiver of certain rights and privileges, as part of the conversion from G4 to green card affect my tax responsibilities?
It doesn't affect them. Everybody that becomes at the IDB, everybody that becomes an employee has to sign the waiver of immunities and privileges, the I-508, in order to transition to a green card. But what happens is the tax law overrides that in the case of an agreement between the U.S. and the IDB, and you still are tax exempt on the wages that you receive from the IDB.
So the next question may be related to tax residency. If you're a retiree, live in the US 6 months and 6 months in your home country, and live only on your pension. The question seems to be about tax residency. And again, if you are being present in the US because of your green card, then you're absolutely a tax resident. If you're just coming here under a visa, then you're subject to the substantial presence test, depending on the days of presence and the formula that we discussed. As long as you're spending on average more or less 4 months every year, year over year, you are probably a tax resident and subject to taxes here.
Right, and so if the person's coming about 6 months a year, they probably will meet the substantial presence test and become a U.S. tax resident.
A U.S. citizen living abroad most of the year, receiving income from the IDB pension, may have some real estate assets transferred from an inheritance abroad. What is taxable and when?
A U.S. citizen is subject to U.S. tax and is eligible. Well, let me just say this. It doesn't matter, as Jose was saying, if you're a U.S. citizen with regard to your taxable income, because you're taxed on a worldwide basis. If you're a U.S. citizen, it doesn't matter how many days you spend outside the U.S. and how many days you spend inside the U.S. You'll be taxed on your full worldwide income. Now, an inheritance from a foreign person to a U.S. citizen is not going to be subject to tax to that U.S. citizen, and just that this gets into the estate tax area, which gets a little bit complicated, but generally speaking, if you inherit a piece of real estate, let's say, from a foreign person in the foreign country, you'll get a step up in U.S. tax basis to the full fair market value of the property when it was transferred to you after, or at the date of death of the person you're inheriting it from. So you get a step up in tax basis at that point. And so if you were to sell the property in the future or just immediately, there probably wouldn't be no gain or loss because you got that step up in tax basis.
The next question refers to the difference between taxation of green card holders in the IDB versus the UN. Now, without going into the specifics, the most important consideration is that IDB green card holders are non-taxable, whereas UN green card holders are taxable. How do you distinguish non-willful failure to file FBARs from willful or reckless behavior, and what evidence is looked at?
This is not my particular subject matter expertise. I would refer you to a tax lawyer or an accountant that does this on a regular basis. So I think we have to skip that one. As a matter of fact, I think our time is running up. Maybe we'll go one last question.
Yes, maybe one or two. The next one is straightforward. As a U.S. citizen living abroad, as we discussed, you are always considered a tax resident and subject to U.S. federal taxes.
Right.
I think Marilyn is back, so we'll stop here. Thanks.
I am back. What a great, great session. Thank you to you both. I know there were a lot of questions being thrown at you, and you are obviously the experts in this scenario. So thank you for your expertise. Team, we will be putting, I believe, the PPT in the chat so you can download it. We will also be sending a follow-up, and be sure to come visit us. As you can tell, there's a lot of nuances in taxes, and you probably have specific questions. So please feel free to reach out to our experts and also come visit us. And if you need any financial services, we are always here to help. So thank you, everyone. Have a great day, and we'll talk to you soon. Ciao.
Thank you. Thank you, everybody.
Thank you.